Hello accounting students. We are working through a homework problem for the for the accounting cycle chapter. And this homework problem is going to show you how to post journal entries and post to the accounts. Okay? We have the selected information and account balances of the Sawyer Company on May 31st. We start with cash. And we go down through utilities expense, and now we have the transaction starting on June 30th through June 3rd through June 30th, okay? And now our requirement is to record the transactions in the general journal and post to the accounts. Okay, the first one, it says sold for $700 office equipment that had $2,000 of cost and associated depreciation of $1,500. Okay, our journal entry is to debit cash because we got the cash. Okay, so that's an increase of our cash by $700 because we sold it for $700. All right, and now we have to get rid of the asset, and the equipment had an original cost of $2,000, so you have to get rid of that off of our books, so we credit that for $2,000, and then we have a debit to accumulated depreciation of $1,500 because we're getting rid of that asset. So when we get rid of the asset, we also get rid of the accumulated depreciation. Okay, and then the difference between our debits and our credits is a credit of $200. Okay, $2,200 on each side to make sure the debits and credits match. And so, since it's a $200 credit, to make it balance, we know that the account has to be a gain on the sale of equipment. If it were a loss on the sale of equipment, we would have a debit there. Okay, and now we're going to post it to the account. So on June 3rd, alright, we got $700 of cash, and then we had equipment, $2,000 go away, and we had accumulated depreciation of $1,500 go away. Okay, and then we had a gain on the sale of equipment of $200. Alright, and so to make sure our credits and our debits equal, they do. That's 0. Okay, I don't know what happened. June 3rd. Okay. So our debits and credits equal, and so that we posted them to the accounts. So remember, we sold it for $700, so our cash goes up by $700. We got rid of $2,000 of office equipment. We got rid of accumulated depreciation because remember, accumulated depreciation is a negative number, right? It's always a credit. So we debited it by $1,500 to get rid of it, and then we had a gain on the sale of equipment of $200. And remember, gain on sale of equipment is an income statement account, which a credit increases the gain. Okay, and now our balance is to 0. Okay, the second one, made sales of $2,000 on credit. The cost of inventory sold was $1,200. Well, we're going to go ahead and just post it to the account, just so you'll see. Alright, so we had made sales of $2,000 on credit, so we had sales of $2,000. Okay, we had, and it was a credit sale. That means the other side of it, actually, that's an increase, right? Because credits increase sales revenue. The other side would be to accounts receivable because it's on credit, so they still owe us the money. Okay, and the cost of the inventory sold was $1,200, so our cost of goods sold increases by $1,200, and we sold the inventory, so we don't have that inventory anymore. So that's $1,200. negative 1200, credit there, and make sure our debits equal our credits, which they do because it balances. I'm going to format this to a general so you'll be able to see that our debits equal our credits and it balances 0. Okay. Now, June 10, purchase $1,000 of inventory for cash. So, June 10, we have inventory increased by $1,000, right? And then we use cash to do it, so that's a minus $1,000. Okay, so we traded cash for inventory. Okay, and does it balance? Of course it does because it's 0. Okay, and then June 15th. Okay, we had purchased new office equipment for $4,000, so that increases by $4,000. Okay, and we paid $1,500 in cash, so our cash goes down by $1,500. And we signed a 90-day note for the balance, so we have a note payable for the balance, which would be $4,000 minus $1,500, which is $2,500, and so our note payable goes up by $2,500. Okay, remember that accumulated depreciation is a normal negative credit balance. Notes payable is a normal negative credit balance. Sales revenue is a credit balance, and gain is a credit balance. So remember that when you're posting these journal entries. And so our balance is 0 because our debits equal our credits. Okay, and so we know we're in balance. All right, June 15th. Now, June 16th, we received a check for the June 7th credit sale. Okay, so we had a check, so our cash goes up by $2,000, right? And accounts receivable goes down by $2,000 because we got the cash. Okay, and that was what, June 16th? Okay. And then June 17th made cash sales of $4,200 and the inventory cost was $23. Okay, so we made cash sales, so what date was that? June 17th. So cash goes up by $4,200 because we sold it for cash, so we got the cash. We have sales revenue, so record our sales revenue. Okay, and then our cost of the inventory sold was $2,300, and so cost of goods sold goes up by $2,300, and our inventory goes down by $2,300. Okay, and are we in balance? Yes, we are in balance. Okay. Now June 17th, now June 20th. Purchased $2,600 at inventory and credit. Okay. June 20. So inventory on credit. Let's get us some room here. Okay. June 20. $2,600 in inventory on credit was a purchase, so our inventory goes up by $2,600, and we purchased it on credit. That means we did not pay cash. Okay, so that means we have a payable for $2,600. Let's make sure. June 20th. Yep, $2,600 inventory on credit. Okay. I don't see an accounts payable on here, so I want to post it to the notes payable. Alright, and we are in balance. June 20th. June 24th, returned $200 of the defective inventory from the June 20th purchase. Alright, June 24th. Okay. So, our inventory goes down by $200 because we returned it. Okay, and our payable goes down by $200 because we returned it. Okay, right? Did that happen on the 24th? Let's see. Yep, returned $200 of inventory from the June 20th purchase. And so, yep, so we took the inventory out of inventory because we returned it, and then we don't owe as much on credit. Okay, and we're in balance. So, June 24th. Okay, June 29th, we paid for the inventory. We paid for the June 20th inventory less the return. So, we had cash, because we paid for it, for $2,400, right? And then our payable goes down by $2,400. Okay, so we paid for the inventory, and our payable goes down because payables, remember, always has a credit negative balance, and so when we put a positive debit there, our payable goes down, right? Okay, June 24th, June 29th, and June 30th. Okay, that was June 29th. Alright, and then we have June 30. Okay, June 30 is paid the monthly utility bill for $210. Already paid that in cash, minus $210. And then utilities expense goes up by $210. Okay, so there we have it, and now our balances at the end of the period, can't spell, balances, that's right. And so all we do is we can sum this whole line all the way to there, and our new balances at the end of the month are right here. Okay, so that's what we have in each of those accounts as of the end of the month after we posted to those accounts. Okay, now we can post journal entries, and I went ahead and did that, and all the journal entry is just a different representation of what we've already done. Alright, so there's our June 7th journal entry, our June 10th journal entry, our June 15th, and so on. Okay, and those are all the journal entries that were made. Okay, but it's easier to see it kind of when I posted them to the accounts already. You can see where the transactions occurred. Now remember, assets are debit accounts. Okay, so assets go up with debits and assets go down with credits. Alright, and now that means that liability accounts go up with credits and down with debits. Okay, so liability accounts are just the opposite. So they go up with credits and down with debits. Okay, now income statement accounts are a little different. Alright, revenues go up with credits and expenses go up with debits. Okay, and at the end of the day, we want revenue to be higher than expense, right? So our net income is usually going to be a credit, which goes into equity, and equity is a credit balance account. That's why revenues are credits, okay? Because revenues increase equity, and equity is a credit account, okay? Anyway, this is a great example for you to work through, and I'll post this Excel spreadsheet and this presentation so you can watch it as many times as you want for a great example of the accounting cycle. Thank you for your time.